In 2011, a man named Alex walked into an authorized Rolex dealer in London and bought a stainless steel sports watch for £4,800. Nothing dramatic, just a purchase. Except 10 years later, that same watch was selling at auction for £18,000. He didn't do anything clever. He didn't time a market. He just didn't sell it. And somewhere in that story, an entire industry got built. Watch flippers, watch funds, watch indices, gray market platforms doing billions in annual volume, Instagram accounts devoted entirely to wrist photography. But here's what nobody tells you at the start. For every Alex who bought the right watch at the right time, there are 1,000 people sitting on watches worth less than what they paid, convinced they're investors, when they're actually just very well-dressed consumers. The question isn't whether luxury watches can be investments. Some clearly have been. The question is whether you, buying in 2026 at current prices with your access, are actually investing or paying a premium to feel like you are. That's what this is actually about. The luxury watch market between 2020 and 2022 did something genuinely strange. It lost its mind. A pandemic hit, travel stopped, experiences evaporated, but money for a specific slice of the population kept accumulating. Stimulus, rising asset prices, near zero interest rates. And some of that money found its way into watches. The Rolex Daytona in stainless steel, retailing around $14,000, was trading on the secondary market for $40,000, sometimes $50,000 in 2021. People were flipping watches for profit within weeks. Financial journalists who covered equities were writing pieces about watch portfolios. It felt like a gold rush. Then came 2023. The watch chart's overall market index dropped 30 to 40% from its peak for the most traded references. The Patek Philippe 5711, which had touched over $100,000 on the gray market, pulled back hard. Some references fell close to retail. A few fell below. By 2025 and into 2026, the market has stabilized, but it has not recovered to those peaks. And that stabilization tells a very specific story about what this asset class actually is versus what it was sold as during the hype years. Right now is the clearest moment we've had in years to look at this honestly. Stay with this, because in a few minutes, we're going to run the actual math. The number that watch dealers, gray market platforms, and most watch investment content would prefer you never calculate yourself. The watch market has layers most buyers never see. Layer 1 is the brand and authorized dealer. Rolex, Patek Philippe, Audemars Piguet, Richard Mille. They manufacture, they set retail prices, they control supply deliberately. The authorized dealer sells at brand-mandated retail, no markups allowed officially. So how does a $14,000 watch end up selling for $40,000? It doesn't happen at the authorized dealer. It happens at Layer 2, the gray market. Secondary dealers, auction houses, private platforms. Prices here are set by supply and demand, not by the brand. And the mechanism that creates the gap is deliberate scarcity. Rolex makes fewer popular models than the market demands. This is policy, not logistics. A product that's always available loses mystique. Manufactured scarcity creates desirability. Desirability creates gray market premium. Gray market premium creates the investment narrative. You are not just buying a watch, you are buying into a deliberately engineered scarcity story. Alex once asked an authorized Rolex dealer how to get on the wait list for a stainless steel Submariner. The dealer told him there was no wait list. You build a relationship, you buy other pieces, you demonstrate loyalty, and eventually, maybe, you get offered the watch you actually want. That's not a purchasing process, that's an audition. Layer 3 is the collector and investor community. People who tracked secondary prices early, built authorized dealer relationships, bought at or near retail before the premium exploded, and held. These people made real money. The data is genuine.
but they largely bought between 2010 and 2018. The window that created those returns has closed, and buying into the story now at 2026 secondary market prices is an entirely different bet. Let's build a real scenario. Alex buys a Rolex GMT Master 2 in stainless steel today. Current secondary market price in 2026 sits roughly between $12,000 and $15,000, depending on reference and condition. Actually softer than the 2022 peak, which should tell you something. Call it $13,500. He can't get it at retail without an established dealer relationship, so he's already paying gray market premium before he even starts. Now the costs begin accumulating quietly. Authentication on purchase, $200 to $400. Annual insurance on a watch worth $13,500, roughly $200 to $320 per year. Full service over a 5-year hold, $900 to $1,200. Rolex officially recommends servicing every 10 years, but real-world wear and collector standards push that closer to 5 to 7 years. Selling platform fees or dealer commission when he exits, 8 to 15% of sale price. Storage, minor costs, real nonetheless. Total carrying costs over 5 years, conservatively $3,500 to $4,500. Now the comparison that matters. If Alex had invested that same $13,500 in a low-cost S&P 500 index fund, zero carrying costs, zero effort, full liquidity, at a conservative 9% annualized return, he'd have approximately $20,800 after 5 years. For the watch to beat that benchmark after costs, it needs to sell for roughly $17,500 to $18,000. That's a 30% increase in watch value over 5 years just to match what a boring index fund does automatically. Is that possible? Yes. Is it reliable? Is it predictable? Can you model it with any consistency in a market that's already corrected significantly from its peak? That's where the investment thesis quietly falls apart. Because watch prices are not driven by earnings or cash flows or economic fundamentals. They're driven by taste, by trend, by which reference an influential collector decides to wear publicly, by social signals. And social signals shift, sometimes overnight, sometimes slowly, always without warning. And here's the part the watch investment content ecosystem almost never addresses directly. Who actually makes money in this market and why it's probably not who you think. Let's be precise. The authorized dealer with strong brand relationships makes money, not necessarily on retail margins, but on access, customer loyalty, and the halo effect of being associated with desirable pieces. The established gray market dealer with deep sourcing networks and genuine market knowledge makes money. They're arbitraging information and access. They know which references are moving before the data hits public platforms. This is real expertise built over years. The people following that expertise after it's been packaged into YouTube content are playing a completely different game with a meaningful information disadvantage. The early collector who bought for passion and held, they often made serious money, not always. But the person who bought a Rolex Submariner in 2008 because they genuinely loved it and wore it daily, they are sitting on something worth multiples of what they paid. And here's the important detail. They weren't treating it as an investment. They were treating it as a watch. The person buying today at secondary market prices with a 5-year investment horizon and no particular market expertise, the math, as we just showed, does not favor them. Not in 2026, not after a correction, not when high-yield alternatives exist and gray market premiums have compressed. Here's what watch investment content still looks like, and I say this with some genuine affection because it's a compelling genre. A well-dressed person explains that Rolex produces roughly 1 million watches annually for a global market of 8 billion people. They show price appreciation charts from 2015 to 2021. They explain that watches are portable hard assets, not correlated with equity markets, stores of value in inflationary environments. All of this contains real information. None of it is technically false. But the 2015 to 2021 chart is not a neutral baseline. It captures the most unusual monetary policy environment in modern history. Near zero interest rates for years, cheap money chasing yield everywhere, art, wine, sneakers, cards, watches. The watch market didn't appreciate because watches became more useful. It appreciated because capital was desperate for somewhere interesting to go. When rates rose sharply in 2022 and 2023, the opportunity cost of tying up $14,000 in a watch versus putting it in a 5% money market account became suddenly viscerally real. The market adjusted, and in 2025 and into 2026, with rates having moderated but not collapsed back to near zero, that dynamic hasn't fully reversed. The not correlated with stocks argument also deserves
honest scrutiny. Watches don't necessarily fall when equities fall, but they are correlated with consumer confidence, with discretionary wealth, with the overall financial mood of the affluent consumer class. When that mood turns cautious, as it did in 2022, watches feel it too. The store of value argument works at the very top of the market. Vintage Patek Philippe Grand Complications, early Paul Newman Daytonas with documented provenance, pieces with genuine collector history. For the broad watch market, for the references most buyers actually purchase, store of value is a generous description of what is often slow depreciation with better aesthetics than a car. Here's where the watch conversation becomes about something larger. We live in a moment where everything is being financialized. Sneakers have secondary markets with derivative-style pricing. Art has fractionalized investment platforms. Trading cards have real-time price indices. And luxury watches fit perfectly into this narrative because they sit at a very specific intersection of two powerful desires: the desire to be wealthy and the desire to look wealthy. When those align, when the thing that signals status also happens to appreciate in value, it creates an almost irresistible story because it removes the guilt. You're not spending $14,000 on a watch. You're investing. You're diversifying. You're being sophisticated. The watch on your wrist is just the visible dividend. This isn't cynicism. It's an observation that applies equally to the penthouse, the classic car, the fine wine cellar. Human beings have always found ways to make consumption feel like investment. Sometimes it works, often it doesn't, and the line between the two usually becomes visible only in retrospect, and usually after the correction has already happened. There's also an access dimension worth naming plainly. The watches that genuinely hold and grow value reliably, the investment-grade pieces, are largely accessible at rational entry prices only to people who already have significant wealth and established relationships with private banking clients and long-standing boutique customers. For everyone else, the available entry point is the secondary market premium, and that premium is exactly the portion most exposed to sentiment shifts and correction. So, investment strategy or expensive ego? The honest answer is, it depends on the watch, the price paid, your access, your expertise, and when you entered. Which is not satisfying, but it's accurate. What we can say with confidence in 2026 is this: a Rolex or Patek bought at retail with full documentation and held patiently over a decade is likely to hold value better than most consumer goods and potentially appreciate. That's real. The brands are real. The craftsmanship is real. The scarcity management is real and ongoing. But that requires retail access most people don't have, patience most investors don't maintain, and correct reference selection in a market where most references don't perform. For the broader category of luxury watches bought at gray market prices based on the 2020 to 2022 appreciation story, the investment thesis in 2026 is significantly weaker than the content ecosystem around it still suggests. The carrying costs are real. The illiquidity is real. The correction already happened. And the ego element, let's not dismiss it honestly. There is nothing wrong with buying something beautiful because it brings genuine pleasure. A watch worn daily, appreciated every time you check the time, connecting you to a craft tradition going back centuries, that has value, real value. It's just not a financial return, and confusing the two is expensive. Here's what stays with me. Alex, the one from the beginning, the one who bought that Rolex in 2011, when he tells that story, the most interesting detail is what he says at the end. He never bought it as an investment. He bought it because he'd wanted one since watching his father wind his watch every morning before leaving for work. He saved for 2 years. He wore it every day. He never tracked the price. He just wore it. The watches that performed best as investments were almost universally bought by people who weren't trying to invest. They were bought by people who loved watches, understood watches, had reasons beyond money to hold watches, and happened to be right about which pieces would endure. The investment infrastructure, the price trackers, the gray market apps, the watch funds, the content, arrived after the returns were already there. And that infrastructure attracted exactly the kind of capital that tends to show up right when things are about to get complicated. So here's the question worth sitting with before you open the next browser tab. If the best returns in this asset class consistently went to people who weren't treating it as an investment, what does that tell you about the nature of the asset itself? And what does it tell you about why you're here right now watching this video? Think about which one you actually are before you decide. If this shifted something, or if you've been inside this market and seen it differently from the inside, put it in the comments. The real takes, not just the wins. And if someone you know is convincing themselves a watch purchase is an investment strategy, send them this. Not to talk them out of it, just to make sure they're seeing the whole picture first.